Calculating national income, value added or product method. In this module, you will learn about the calculation of national income by value added or product method. The final goods and services produced within the domestic territory of a country constitute the domestic product, and the money value of the same generates the income. This income is finally spent either on consumption or investment. This makes it quite clear that money value of final goods and services is always equal to the sum total of all the factor incomes generated, which in turn equals the final expenditure incurred. Let us understand the product method, which is commonly known as value added method. Value added is the value created by each producer at every level of production. There are certain steps to be followed in order to estimate national income by value added method. First of all the production units in the economy are identified and are classified into primary, secondary and tertiary sector on the basis of their occupational activities. Then, the value of output of each production unit is estimated by adding their sales and change in their stocks. Once the value of output is determined, the value of intermediate consumption is subtracted from the same in order to estimate the gross value added of that unit. If we subtract indirect taxes from and add subsidies to net domestic product at market price, we obtain net domestic product at factor cost, which is the same as domestic income. Finally, the value of net factor income from abroad is estimated and added to the domestic income. The resultant figure is nothing but the national income. We can sum up the value added method like this. Sales plus change in stock gives us gross value of output minus intermediate consumption gives us gross value added. The sum of gross value added by all the units gives GDP at MP minus depreciation is equal to NDP at MP minus net indirect tax gives us NDP at FC. By adding net factor income from abroad to it, we obtain national income. If your father sells his old car to someone, shall it be included in national income? No, it should not be. This is because the value of second-hand goods have already been included in national income at the time of their first sale. Do you know that shares, whether new or old, are merely the paper claims of the real assets, and hence their value does not form a part of national income? Let us recall what we have learned. There are three methods of measuring national income. These are product method, income method, and expenditure method. In product method or value added method, the production units are identified and the output value is estimated. Intermediate consumption, depreciation, and net indirect taxes are subtracted from the value of output to get domestic income. The value of net factor income from abroad is added to domestic income in order to obtain national income. Precautions must be taken while using value added method. These are: only final goods should be included in national income, not the intermediate goods. Sale of second-hand goods should not be included in national income. Sale of shares, whether new or old, should not be included in national income.